Good evening, my professional colleagues, and it gave me great pleasure to have you on another episode of ICAN on Air. Today, Thursday, the 22nd of the month of December. Sincerely speaking, it's been an awesome time, and we have been having it well right from the beginning of the year, and every Tuesday and Thursday is being a superlative time for you and I learning on daily basis. And today I've come with another topical topic that is of great concern to us as individuals, and that is the overview of insurance contract. And to be guesting me today is no other person than Mr. Joshua Ansa. Mr. Joshua Ansa is a partner of the firm of CIO Partners, an independent national professional services with competency in audit and assurance, accounting, tax, international financial reporting, human resources. He holds BSc degree in accountancy from the Abia State University, Uturu, and a master's in business administration from the University of Calabar, Cross River, a fellow of Art Noble Institute, the Institute of Chartered Accountants of Nigeria, as well as an associate member of the Chartered Institute of Taxation. Mr. Ansa has over 20 years of professional experience, both onshore and offshore, spanning accounting, auditing, taxation, financial due diligence, to mention but a few. And he has his link in manufacturing, oil and gas, construction and merchandising, public sector. Our guest today is out there to give us an insight into the overview of insurance contract. And I'm sure we all know the importance of insurance in our daily living, even in the same climate, and that we're going to tap on. Like I keep telling you, as you're making your projection for the new year 2023, make it a point of duty to bring your goods and services to ICAN on Air for us to promote it for you. On that note, I will be going on a very short break, and when I'm back, I'll give you a deep insight into the topic of today. Please stay tuned. I'll be right back. Welcome back, welcome back, welcome back. It's been a great time, and it gives me great pleasure to welcome my guest today, Mr. Joshua Ansa. Good evening and welcome to ICAN on Air.
Good evening, sir. Thank you for having me.
Yeah, it's our great pleasure. And on that note, I will be moving on a V12 engine while we will be giving our members, our viewers who are globally connected, the overview of IFRS 17, talking about insurance contract. And I'll be starting this way. Today we are looking at the overview of IFRS 17, a standard dedicated to insurance contract. Our global audience would like to know what constitutes an insurance contract.
Okay, thank you. Let me start it this way. Insurance contract at this point in time is very important, and it needs all insurers, operators of insurance houses everywhere in the world to be at alert, because by January, the standard will become operative and will be used by all issuers of insurance contracts. So insurance contract is a contract of indemnity, a contract whereby the insurer accepts a significant liability, from the insured, that is the policyholder, assuring the policyholder that he will or she will be indemnified against a specific event if that event happens. And at the other end, the insured will pay a specific sum called the premium to the insurer.
That is a good way to start having understanding of what insurance contract is about. Mr. Answer, I need to pick you up on this. Sir, we have IFRS 4, which was specifically for insurance contract. Now, there is IFRS 17, also on insurance contract. Our global audience are wondering why two standard for insurance contract. Can you run us through the reason for having two standard on insurance contract by giving us the differences between these two standards?
Okay, thank you so much. Now, IFRS 4 is the current insurance contract which is currently being used and which will end as at the close of this year. From January, it will be expected that IFRS 17 will come into force. Now, IFRS 4 was hurriedly put together at the advent of the EU's adoption of the international reporting standards. And so it was aimed at a minimum but not a maximum comparability or a standard that can assure comparability and transparency. And so because of that, since 2004, the ISB had instituted another committee to go into to produce a new set of standards that will ensure a maximum, that will ensure maximum comparability of insurance reports and will bring forth transparency. So you can say that IFRS 17 is the first internationally, international accepted standard that will ensure transparency, that will bring forth comparability of financial statements all over, of insurance companies all over the world. So it came in to introduce a single model that will be used to measure insurance products.
That is a clear extension, and I want to believe that our viewers that are globally connected is having this insight that IFRS 4 definitely comes to an end by the dawn of December 31st, 2022, and we will be looking at IFRS 17 as we move into the new year. Mr. Answer, let me pick you up on this by saying, can you run us through the objective and scope of this IFRS 17 on insurance contract that we will be launching as we enter into 2023?
Okay, so the scope of IFRS 17 will be for insurance contracts that meets the definition of IFRS 17. And it will exclude contracts that can be measured using IFRS 15 or IFRS 9 or IS 29 or IS 19. In that case, the standard is not for contracts of contracts that will, contracts that are being warranties that are given by manufacturers or producers of goods, and it's not also covering contracts that has to do with credit cards or contracts that fixed fee contracts. Those ones will not come under IFRS 17.
Okay, so those two
the IFRS
contracts
17 now comes in to align as much as possible as other standards that deal with revenue to the revenue to customers.
Okay,
and it measures the value of insurance contracts and make sure that it spreads the profit of insurance on insurance contracts over the life of the contract, and then distinguish and separates insurance revenue and insurance costs from finance costs and finance revenue, in which in IFRS 4 it was all lumped together, and then present to investors the reports, what constitutes what the contracts on insurance, the impact that the contracts on insurance can have on the financial statements.
That is a very clear run through of the objective and the scope. And this has actually opened our eyes that IFRS 17 will actually bring our way deeper understanding of insurance and also brings more transparency when it comes to financial statement. Given your very insightful response so far, can you please run us through the basic content of insurance contract that were enabled to identify an insurance contract when you see it? What are the basic content?
Okay. For insurance contracts, there are many insurance contracts that come with the elements of insurance contracts as well as the elements of other contracts, say like contracts for sale of goods or contracts for a fixed fee income or contracts for that contains that that contains investment, that contains investments. So IFRS 17 requires that these contracts need to be unbundled, separated, such that those that concerns IFRS 17 will be measured using IFRS 17, and the other ones will be measured using the specific standard that attains to such contracts.
Okay, that is a clear distinction that we are having when it comes to the basic content of an insurance contract. Let me use this opportunity once again to recognize the presence of our global viewers that are connected globally from the diaspora, those from the northern Nigeria, the western part, the southern part, the eastern part, who have always made it a call every Tuesday and Thursdays to be part of this program. And I want to encourage you that you bring up your question, knowing fully well that we are discussing a topical issue that effective January 1st, 2023, it will come into place and you and I need to have deeper understanding. So I welcome your question globally so that our guest for today can do justice to it. It's still an overview of the insurance contract, IFRS 17. You heard from our guest. We had initially IFRS 4. Now we are talking of IFRS 17 that will give transparency, deeper insight into the topic of discuss. Mr. Ansa, as we
Yes.
proceed, while I welcome the question of my guest, I want to ask, it seems there may be non-insurance content within insurance contract. Our global audience would like to know how the non-insurance element can be unbundled from the contract. Can you please provide us some insights?
Okay. Our insurance contracts sometimes contains other elements of other contracts. So the unbundling will be done by separating those contracts that are purely insurance contracts to one side, and then the other contracts like the contracts with embedded derivatives, contracts with some fixed income or fixed fee income, or contracts that has to do with sale of goods. All of them have to be separated. And then by forgetting it like this and unbundling it, it will enable you to apply, it will enable the insurance entity to apply IFRS 17 only on the, the part of the contract that has to do with insurance contracts, which is the contract of indemnity, indemnifying the holder of the insurance policy when an uncertain event happens. Then for the other ones, like the sale of goods, of course, it will be measured, such will be measured under IFRS 15. And for leases, it will be measured under IFRS 16. And for embedded derivatives, it will be measured under IFRS 9. And any other, elements that could be there will be specifically measured based on the standard that governs such transaction.
Brilliant. And I think that actually give an insight to this. Like you said, while you're trying to make allusion to this new IFRS, I want to say that the topic of today it's a bit technical, and it is those that have deeper understanding of it that can give explicit explanation to it. And I think you are doing justice to that. But I want to pick you on this that. Can you share with us if there is any nexus between IFRS 1, IFRS 7, and IFRS 15, talking about revenue from contract with customer, and IFRS 9 that speaks to the financial instrument?
Okay. There is what all of them are looking at is performance of the contracts and the contracts being valued at a fair value. IFRS 17 also is aimed at ensuring that contracts with customers, that is contracts with the policyholders, are done in a manner that it reflects the current position. That is talking about, the components are being measured using the current market value.
Okay, so it gives an insight of telling you to measure things at the current value. Like I keep saying, the topic of today it's technical, and I expect that our audience that are globally connected brings in their question so that we can have deeper understanding, knowing fully well that the contract of this, the topic of discourse of today, which is IFRS 17 on insurance contract, take effect from January 1st, 2023. While I await the questions from our audience, which I believe they are trying to have deeper understanding of this, let me pick this question, Mr. Ansa. IFRS 17 defines portfolios of contract and refer to some insurance uh, contract as one-off contract, as in one-off of contracts. Can you please educate our viewers what is a
Okay.
contract portfolio and what constitute one-off contract?
Okay. Because of the number of contracts that the insurance entities issue in a year, there is the need for the insurance contracts to put them into buckets,
Hmm.
like put them into groups, and then from groups into portfolios. So a portfolio of an insurance contract is it contains contracts that have similar characteristics that can be managed together, such that contracts from the same product line can be said, they can have similar characteristics and they can be managed together. Say, for instance, third-party insurance and
Hmm.
motor insurance. If
Hmm.
all third-party motor insurance are put together, they can be closely monitored, and the insurer will be able to update the information concerning it, and they can be managed in a manner that the insurer will be able to have a good eye on it. And so that is the reason contracts like the marine contracts or any other contracts, marine contracts and motor vehicle insurance contracts cannot be put together in one portfolio
Hmm.
because they belong to separate product lines.
Hmm.
And so for IFRS 17 specifies that at the least, all entities in the insurance industry must maintain at least three classes of insurance portfolios. One being contracts that have the tendency of becoming onerous at initial recognition. Onerous contracts are those contracts that are a loss-making contracts at day one. Maybe the company can decide to take such contracts maybe because they want to have an inroad to the customer. Maybe they have some other things that they want to get from the customer, and because of that, they might decide to take, a loss-making contract at day one. So such contracts immediately, the result of such contracts must be written off to the profit and loss on day one at inception. So they have a tendency of becoming onerous, that is becoming loss. When the cash flow in and the cash flow out, the cash inflows and outflows are being discounted, and then the insurance risk is being taken away from it, what's supposed to remain should be the contractor service margin. Contractor service margin is supposed to be a positive number. That is the fulfillment cash flow. It's supposed to be a positive number. But when it is negative, then it becomes that contract is onerous. That is, it's a loss at the beginning of the year. So that is the explanation about an onerous contract.
That
Then,
is while okay, proceed, sir. You can
okay.
proceed.
And the second group, the second portfolio which an insurance entity must keep is a portfolio of all contracts in a group that have no significant, possibility of becoming onerous subsequently. And then the third group will be all other contracts that do not fall into the first two groups. So those three groups of insurance contracts must be kept by by any insurance entity. It could be more than that, but at least those three has to be kept. Thank you.
Okay, those three segments that you have explained to us must be kept separately. And while you're trying to give your explanation, you talk about the fulfillment cash flow, and that takes me to the question of Fatbolati Mitope Adeniyi, one of our regular listener, who is asking that you should educate us more on the fulfillment cash flow FCF and the contractual service margin CSM and the impact on IFRS 17.
Okay. The fulfillment cash flow is the result of what four components or four blocks. The first is the cash inflow. The second is the cash outflow. Cash inflow is the insurance premiums. Cash outflows are the payments, say like claims and all the other things that are being paid. And then the third component is the discount factor, which is applied on the cash flow. And then the fourth component is the insurance risk, which is an amount the insurer adds, puts on top of the business so that he will be able to, or he will be eager to take the risk. That is the insurance risk. So after putting those four together, you have the fulfillment cash flow. The fulfillment cash flow, when turned at the other end on a negative side, becomes the contractual service margin. The contractual service margin is supposed to, as at this IFRS 4, the contractual service margin will be regarded as profit. But on IFRS 17, the contractual service margin has to be carried forward. The only portion that will be, put in the year, that will be passed to the profit or loss in the year, will be the portion that is earned this year. The contractual service margin is the unearned profit of the insurance entity at any point in time, such that it is the liability, of course, which you are yet to provide cover for. And so only the amount of, the amount equating to the time point that you have provided cover is what you can recognize during the year. That is the one that you have earned during the year. The ones that pertain to other years, future years, has to be carried forward. So
This
that's
is
all
a
about
this is a great insight talking about the FCF as asked by our regular viewer, Fagbola, all the way from Ibadan. I've been guesting Mr. Joshua Ansa, a member of our great institute who have deep knowledge of this insurance contract, and he has been doing justice to some of the things. part of the things we try to do is to bring up contemporary issues. For the benefit of those that are just joining us, I want to tell you that this contract of discuss today, which is the overview of IFRS 17, is something that will come to bear by January 1st, 2023. In the last few years, we've been running through IFRS 4, but that will definitely terminate by December 31st, 2022, and we'll go straight to IFRS 17. And Mr. Ansa has been doing justice to that. I want to go on this question. What is segmentation and come back while I go on the break. But before Mr. Answer, that what is segmentation and cohorts within the context of IFRS 17?
Okay.
Can you hear me, sir?
Yeah, please come again.
Okay, apology. There seems to be a small interference there. I'm asking what is segmentation and cohorts within the context of IFRS 17?
Okay. The standard requires that the insurance contracts that has been identified, measured, has to be segmented, and then they have to be, the contracts have to be segmented into groups, into portfolios, and into cohorts. Cohorts means that these contracts are put in a manner that are put together in a manner that no contract within a certain group is more than 1 year. The reason being that they do not want the volatility of discount rates to affect the outcome of the contract valuation, which will be done, and the liability valuation. So cohorts are time buckets, or cohorts are, like you would say in a group. Cohorts is the list of the group. From cohorts, you have the groups, and then you have the portfolio. But cohorts, in a cohort, contracts that are issued which are a year apart cannot be put in the same cohorts. That's why we have annual cohorts and we have shorter time cohorts. Shorter time cohorts are preferred because it will reduce the volatility of volatility of interest being or acting negatively on the result that will be obtained.
And that is just a clear distinction of segmentation and cohort within the context of our discourse of today, which is insurance contract. I've been guesting Mr. Joshua Ansa, a partner with CL consulting firm, and also a member of our great institute, the Institute of Chartered Accountants of Nigeria. Like I keep telling you, that the best place to display your goods and services is to come on ICAN on air. Promote it. You will not just have only the local patronage, but globally accepted members who are connected to this program will definitely patronize you. And I always flag it every Tuesday and Thursday. I wait for you on that. Mr. Ansa, let me quickly go on a very short break, pay some bills. I appreciate even our members that have been with us right from the beginning of the year. I can tell you for free, this is the Yuletide period, which every one of us needs to give appreciation for everything. On that note, I will go on a very short break, come back, and we'll continue with our discussion. Thank you.
Thank you.
Welcome back, welcome back,
Okay.
welcome back. And that is a big appreciation to all our guests that we've had on ICAN on air. List most of them will keep giving you appreciation in bits as we have it all over the year because it's a great insight coming to give exposition to our members, and we appreciate you for this. And to all our members, we say a big thank you for always being there every Tuesday and Thursday. If you are not there, I won't be here. And I'm sure our guests will not be really impressed to be here. But because you are here, it gives me the energy and my co-hosts to make sure that we are here. The editorial board are always on the move to make sure that we give the best to our members. And that we are doing today. Guesting Mr. Joshua Ansa, talking to us on the overview of the IFRS 17, talking to insurance contract. We've added, we had insurance, IFRS 4 as insurance contract. Again, IFRS 17 as insurance contract. But he's been able to put the extension saying IFRS 4 would definitely go with the passage of time as we wind up 2022. And as we launch to 2023, which is part of the things we've been discussing in the last few days, we'll launch into IFRS 17, and we've been doing justice to this. Mr. Ansa, we'll
Yes, sir.
proceed, and I'll pick you on this question. There are basic measurement model prescribed by IFRS 17. They include GMM, PAA, and VFA. Can you educate our global viewers on this measurement model and their importance within the context of IFRS 17?
Okay. Thank you so much. IFRS 17 provides three measurement models, but there is a one that is the overall model, talking about the GMM, the General Measurement Model. That's why it's called General Measurement Model. It is we would say, it is the model for the IFRS 17. It is the default model. And so the model measures insurance contracts in a manner that it gives the value of the contract in it gives the value of the contract in a manner that it reflects both the timing of the cash flows, the volatility of the cash flows, the timing of the cash flows, and it gives the timing, the volatility, and the pattern of the cash flow. It reflects everything and gives us the general model. So the general model is exactly what we had described, what I had described before. It makes use of some blocks called the building block. It could sometimes be called the building block. The building block is called building block because the contents of the blocks are being worked on separately before ever they are put together to give the contractual service margin. Those building blocks includes the cash inflows, the cash outflows. It includes the discount factor. Discount factor, there are several methods of arriving at the discount factor based on it, and it will be based on what is on ground. And then after that, there is the insurance factor, the insurance risk factor. And then when all that is put together, you have the fulfillment cash flow. So the general model makes use of all this, and it goes to taking the CRM and making sure that it is being spread over the life of the contract. Now, the general model is mostly used by companies that are in the life sector. But besides the general model, there is the PAA, which is adapted from the general model, and also the VFA. The PAA is the premium allocation approach. The premium allocation approach is almost like the IFRS 4 that we're having right now, but it has a little difference in the sense that the premium is not regarded as the income of the entity, but rather the income of the entity is arrived at when the components are being worked together, and it produces a result, and that result is now what pertains to the current period is what is taken as the income, the insurance income for the year. And also, the disclosure of the insurance results is separated from the finance results, as well as being separated from any other business that the company can be engaged in, such that you have the finance income and revenue, or the finance income and finance expenses separated from the insurance income and insurance expenses. Then the other model is the variable fee approach. The variable fee approach is applied on contracts that have discretionary participating features. That is, those contracts that have embedded derivatives that have to be, measured based on IFRS 9, while some part is measured based on the GMM, the IFRS 17. And so those three methods cannot be used by the same company. They have to choose which one to use. Mostly the non-life company, that is the general insurance, are basically using the PAA approach, that is the premium allocation approach, which is of lesser burden and does not really require so much of data, information, and etc. as the general model. But the general model requires so much of data gathering and processing before ever you can arrive at the numbers to be used in the financials. So those are the three models that is being that the IFRS standard 17 permits.
So ISRS permit three models for measuring, and that is GMM, the General Measurement Model, the PAA, the Premium Adjustment Model, and the
Premium
VFF,
allocation approach.
Premium Allocation Approach,
Approach.
and the VFA, which
Yeah.
is the Variable
Variable fee
Fixed
approach.
Fee
Yeah.
Approach. These are the three, and you've explained to us that an organization cannot make use of the three, but they just have to decide on one. But basically, the general insurance policy makes use of the PAA, while the GMA is being
Used mostly by life insurance companies.
that it will want to pay. Fadola is coming back to ask, what can make indemnity of insurable interest go bad, and what is the position of IFRS 17 on this?
What can make indemnity of insurable interest?
Yeah, go bad.
Insurable interest is an interest that anyone has in the insured event. How does it go bad? I think that question needs to be reframed, please.
Okay,
So
so
first,
okay. Well, Fagbola, we'll need a better exposition to the question, because he's asking, how does the insurable interest, how does it go by? If you can put more expository, explaining more on this so that our guest can do justice to the question, we'll welcome it back. We'll proceed as we gradually custom on the topic of today, which is on an overview of the IFRS 17. I have to emphasize on this for benefit of those that are joining us that we have IFRS 4 and 17 that speaks to insurance contract. And our guest for today is giving us an overview of the IFRS 17 that will take effect from January 1st, 2023, when we do away with IFRS 4. Mr. Ansa, while I wait Mr. Fagbola to give clearance to the question, digitalization has taken over the business environment, and insurance industry is particularly impacted by the digitalized evolution. Can you please run us through the changes that have already taken place and the one expected to take place within the insurance accounting in terms of data, system, process, software? Can you, expatiate on this for the benefit of our viewers?
Okay. The benefits of digitalization is not really in one sector. It cuts across all sectors. In the insurance sector, for the implementation of IFRS 17, all entities will need to do a lot on their data capture mode, the way the data are being captured, the way data are being assessed, and the way the data is being stored, so that they can, so that whatever system that they will use or softwares that they will use, the data will be easily assessed and can be made use of. Now, also the coming in of IFRS 17 will bring so much, financial stress on companies. Of course, they will need to have new softwares. Not many companies, insurance companies, especially here in Nigeria, are having the softwares that can run, the IFRS, that can turn out the reserving for the IFRS 17 as is required by IFRS 17. And so what companies need to do first and foremost is to take a study, a gap analysis, and look at the what they have presently, and then look at what the IFRS 17 specifies that they need, and such that they will now know what gap exists, and then you'll be able to, block the gap by, you know, ensuring that those, uh, you know, uh, those technical needs are being met.
Okay, so
Okay.
these are some of the things that we expect some of these organizations to make here. Fagbola has come in to give clarity to the question of what he meant by indemnity going bad. And he's saying at the point of indemnify, you are able to get the full value expected from the insurance concern. What is the
Okay.
position of IFRS 17 on this?
Okay. There is what we call, when contracts are being made at the beginning, certain information concerning the contract, of course, needs to be gotten, and those informations should be accurate. Most times, insurers do not, the insured do not want to disclose, maybe the real value of what they want to insure. It might only be at the point of indemnifying, when anything happens, that they will now say, no, the value of what I insured is XYZ. Whereas what they had declared at the first instance was a lower value. And so if during during the period of coverage, there is, of course, a hint that the value which you had given before was less than what it ought to be, or maybe inflation has really eaten deep into it. What you might do is, you might ask for a contract a review. If a contract review is done, of course, you can cover any point or any, of those gaps which you might think, of course, when you are being indemnified, it will not cover everything that you had suffered. So when that is done, when there is a contract modification, then such gaps can be taken care of. And that is the provisions, of course, that
Okay,
is in IFRS 17. There could be
okay, that
contract.
is the profit. Yeah, okay, that is the provision in IFRS 17. And I want to believe that $5 has been able to pick up a point from what our guest has explained. While we proceed, I have Uche Naorizo, who is appealing that you please give us the model that you said applicable to general insurance, and also speak to the FCF and the CSM. That is the fulfillment, cash flow, and the other. Can you give a further explanation on this as we gradually
Oh,
wind up?
okay. The model that can be used for general business is the PAA. On the PAA, the standard gives you, an allowance to assume that none of your contracts are onerous at inception. But if you are using the general or the PAA, the cash flows of your entity must not be, must not be significantly variable. Those cash flows should be predicted. They should be what has already been, of course, agreed. But if there is substantial variability in the cash flows, then you cannot use the PAA, even though you are doing general business. You'll be asked to use the VFA. Now, for the PAA, the reserving will be done best just like you are doing on the IFRS 4 now. But the the presentation in the financial statements, of course, the presentation in the income statement as well as the statement of financial position will differ from what it is obtainable now. And then, but also, if you are using PA, you might not need to bother yourself about discounting because it will be, of course, within 12 months. And even though you discount, it might even out at the close of the year. So you might not bother yourself about discounting. But if you have, the premium is material, definitely you should discount it. And then you had also asked about the fulfillment cash flows.
Yeah,
Your
the
fulfillment
fulfillment cash flow. Yes, sir.
Okay. Fulfillment cash flow is usually obtained by discounting both the inflows and the outflows. The inflows being the premium received and any other, money that is received in respect of that contract. And then the outflows will be the claims that are being paid and also whatever expenses that you have incurred in procuring the contract and any other expenses that is being used in managing the contract. Those will be the cash outflows. And so those two will be discounted. If they are material, they have to be discounted. And then the insurance risk also being passed through it. And then you have the fulfillment cash flows.
And I can tell you that the topic of today, even though very technical, our guest has been able to simplify it. And I'm sure our members are fully prepared as we launch into the year 2023 and we have the IFRS 17 to take effect. In closing, our guest today, ICANN is always open to ideas that will positively advance the growth of the members, the accountancy profession, and Nigerian business environment. As we are winding up to kiss the year 2022 goodbye, what is your advice or suggestion to our institute, the members, on further contribution in the discourse on the adoption of IFRS 17 by insurance company come January 1st, 2023?
Okay. The advice will be, of course, for members of our institute to get involved more, of course, in understanding the insurance business because not many are in the insurance sector. Not many auditors, not many consultants go to the insurance sector. Insurance sector is a unique sector that, there are many things that they do that are not common to the other sectors. So we should get involved. Also, the standard is, of course, daily being reviewed. Of course, we can set up a theme that can look at those areas, of course, that will affect, entities in our own, jurisdiction, and then offer such, suggestions to the ISB.
That is a great way to bring the show to a close today. I can tell you for free from what our guest said. Insurance, it's a topic, it's a project on its own. It's a business on its own. And he has advised us as member to get involved, have deeper knowledge. I'm sure the reason why I didn't have trickles of question today is the technicality that is involved in insurance topic. On this note, I want to appreciate our guest for today, Mr. Joshua Ansa, a partner with Ciao Consulting, for being our guest this evening on ICAN on Air. It's been a wonderful time giving us an insight into what will definitely launch by January 1st, and that is IFRS 17 on insurance contract. And on this note, I will call it a day today, wishing all our viewers connected globally Merry Christmas. And I want to tell you, I'm sure you've had a word from our president celebrating the Christmas with you. Stay cool as you have the long holiday. But between the holiday, I'll definitely connect with you on Tuesday before you resume back on Wednesday for those that are still in line, to make sure that you have the best of the best in preparation for the year 2023. And on that note, I want to appreciate our guests, appreciate all our viewers connected globally from the north, south, east, west, and south of the country, that you are always there. That is the reason why the editorial board, we always put in their effort to make sure that we are here. On that note, I call it a quit, and I remain your host on Anchor, on ICAN on Air, Olusesan Okwade, FCA, till I come your way next week, Tuesday, the 27th day of the month of December. Please enjoy your Christmas and be cautious. Let there be moderation in all that we do, and I will connect with you back. I will leave you in the hands of our producer as we give you the appreciation to round up the program. Thank you, and bye for now.